Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on how poor job numbers hit the U.S. markets. Oil and Gas Investments Bulletin editor Keith Schaefer talks about crude oil's recovery. RealEstateTiming.com's Robert Campbell on the hazards of Vancouver and Toronto's skyrocketing real estate. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always nice to be with you, Jim.
The latest U.S. unemployment numbers came out. They weren't pretty, and it's really had a snowball effect on their markets.
Oh, yeah. Worst numbers in 5 years or more. You've got unemployment rate looks good, but it's only because the participation rate is dropping. You have over 50 million now who have given up on looking for jobs, so that it makes the unemployment rate look better, but the total number is not good. And even if you allow for the Verizon issues that happened in the last month, you still have one of the worst months that we've had in a long time. So this really caught the markets off guard. There've been talk over the last week or two that potential rise in rates from the Fed at their next meeting this month was pretty much on the table and open for more than just discussion, but a high probability. So as of the employment numbers now, that will definitely go to the back burner, and September at the earliest would be the time we'd look for a rise in rates. So with that, the markets react immediately. U.S. dollar was down over 1% on the day today. Canadian dollar up about 90 points. So lots of strength, lots of movement away from the currency, just because that interest rate differential clearly is not going to be there. So the hot money looks for an exit door.
One of the officials at the U.S. Fed said, we may not raise rates this year. We may not raise them for years. Well, people tend to move with the pendulum from one side to the other. I think you have to take all of those comments with a grain of salt and look at who they've come from. And, as they've said all along here, they are watching the data. They are data dependent. And until they can see some consistency, then clearly a rise in rates is out there in the future. Whether the future is 3 months, 6 months, or a year, anybody knows. We take a look at what Japan has gone through in the last 20 or 30 years, low rates and just staying down. So who's to say that we're not going to stay down as far as the U.S. numbers are concerned? And when you've got these low rates once again, without that concern of a rise, the gold market gets a bid. We had sold off in the last week or so from 1,300 down to 1,200. The 1,200 is a good support area. We had looked at that broadening megaphone pattern in the price that when it failed to hold in the 1260s, the assumption was that you would then test your next lower level of support, which was going to be in that 1206 to 1220 range. We spent the better part of 4 or 5 days down here, had a really good bounce today up through the 1240s, but I think we will still look for overhead resistance in the 1250 to 1277 area, and we'll see just how much strength there is at this point. A good reaction today, but it'll be a question of how much follow-through there is in the next week or so. The miners had just a fabulous tail end of the week, up anywhere from 7 to 11% on the day on Friday. They had been down with gold and with silver in the last week or so, but not as weak. They had only corrected back to the support levels at the March high, whereas the bullion had been down through the bottom of that into the March lows. So the miners continue to see upward pressure, and who's to say that we won't be seeing new highs in the miners in the short term?
What's the long-term outlook for equities in Canada and the U.S.?
Well, I tend to, look at it more on an intermediate scale. You look at the seasonality movements. First, the stretch from the end of November through May tends to be one of your best stretches. Then you go through that questionable period in the summer and into the fall. From where I sit right now, if we were going to sell off, the opportunity was going to be in mid-May through early June. That's the classic where you would have your initial sell-off and then get your summer rally. And with the news that we've had this week, and take a look at the employment numbers on Friday, the markets have held exceptionally well. They had been a little bit oversold the middle of last month and held in very, very well. So I think the probabilities here, the market's going to try and push higher for probably a 4 to 8 week window. That's the way the technicals are lining up right now. And it would really take a violation of that mid-May low to turn us negative on the intermediates from our perspective right now. But as we get into July, I think the markets clearly have some vulnerability as we move into the fall, and you want to be nimble once we get to the middle of the summer. Look to take some money off the table, and hopefully there's some bargains that appear as we enter September, October.
I think people should keep in mind what happened last August 24th could happen again.
Yes, this is a market that's rolling a little bit like it did last year, just doesn't have the momentum. You got some mixed pictures when you take a look at things like the advanced decline line, which has been doing well. But if we look at the equal weighted indices, like the S&P equal weighted versus the capitalization weighted, it's starting to underperform. You look at the Dow transports, they've been underperforming the industrials. That was one of the warning flags that we had a year ago as the markets were rolling, and we're seeing that again right now. The highs in the last couple of weeks on the transports are nowhere near what they were 2 months ago, whereas the Dow is up and just, teasing against those highs. So if we continue to see some strength in the industrials without the transports, that to me would be, an omen of some difficulties down the road.
Ross, thank you very much for chatting with us.
Always a pleasure to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions or comments for Ross, you can email him at ross.clark@cibc.ca. Coming up next, Keith Schaefer on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, the website oilandgas-investments.com. Welcome to This Week in Money, Keith.
Jim, I'm happy to be here.
Can you tell us a little bit about the Oil and Gas Investments Bulletin?
Oh, yes. It's a subscriber-based service that basically follows my personal portfolio. So whatever I'm buying and selling in the markets in energy stocks, and that's all I do all day long, is research these things and try and figure out where I can make the most money for me and my family. And so they're all real hard money trades that we put on the portfolio, and then I basically explain my trades and the reasoning behind them with as much context as possible. The whole point to the letter, what really makes it accessible for everybody, is the very simple language that I explain the energy sector, what motivates the traders and the buyers, what motivates the management teams, why certain assets perform better. I just divide up the zoo so that everyone knows what the animals look like, how they operate, and how we can make money doing that.
How does the energy sector look right now as an investment?
Oh, Jim, honestly, we have never been looking at a more bullish scenario for the upstream, the producers, part of the market in years. For the first time in a really long time, like we'd have to go back probably to the early part of this century to get a situation where both oil and gas fundamentals are lining up so bullishly. Production is declining in both of them. So, we've had a glut for the last 3 years, really in both oil and gas, and certainly in the last year and a half, valuations of these stocks went to crazy low levels. So now what we're seeing is that in the last 3 months, a lot of these stocks have doubled already as they came off lows that were just complete washout lows, where the market had given up the ghost, all hope, and then as oil started to rise, oil's gone from 26 to 50 in the last 3 months. The leading oil stocks have doubled, and now they've just got kind of normal valuations because oil's doubled with it. And now what we're seeing with nat gas has had a monster run in the last 4 days. A lot of it's technical buying. We kind of broke out above the 200-day moving average on the nat gas price, but what's happening there, Jim, is that for the first time since 2009, we're getting a production decline in the United States. We've been as high as 75 billion cubic feet a day, which is a monstrously large number, Jim. 75 billion cubic feet a day. And now we're actually down under 70. We're in the 69s now. And that might not sound like a lot, but the one part of the natural gas market that a lot of people have not paid attention to is that demand for natural gas has pretty much kept pace with production. Not 100%, but pretty close. So for the first time in a long time, you're seeing demand this year, which is running about 4 to 4.5 billion cubic feet a day more than last year, way outpaced demand, or way outpaced production, sorry. Like production is flat to down maybe 0.5%, so, or 1%. So that's creating a much tighter natural gas market. And so you're seeing natural gas the last few days basically jump from 2 to 240 per MMBTU, which is British thermal units. So that's a big move. And really, because the market is really excited about this trade again, you're starting to see a lot more speculative activity come into the market. And we all know, Jim, when the spec trade starts to get on, it'll really, whatever direction prices are going, it'll make it go even more. Like it kind of becomes a case of the tail wagging the dog. But certainly the fundamentals, Jim, yes, in answer to your question, the fundamentals right now in both oil and gas have never been as bullish as they are right now for years.
Is that good news for BC's Peace River District, which is very heavy in natural gas production?
Absolutely it is. Now the sad part about this is that of all the areas in North America that are going to benefit, it's going to benefit the least, simply because Canadian inventory levels for natural gas are really high, much higher than American levels. So, you think of where all the demand is for natural gas. It's down on the Gulf Coast, Louisiana, Texas, and on the northeast U.S., where all the heavy population is, from basically Washington up through north of Boston. So we're as far away from that as you can be. So we are, we get our transportation costs to get there are the highest because we're so far away, and so therefore our gas prices are the lowest. So we have not, we've still seen actually a big jump ourselves. We got down as low as 85 cents about 3 weeks ago, and now we're about $1.40. So that's a big jump. But whereas the U.S. market really never went down much below $1.80, the Canadian prices went down a lot more. So certainly going from 85 to $1.45, Jim, is great news. But really, we still need 2.25 to make good money. There's the odd producer, Jim, that can make money here at this price, but for almost all of them, well, at $1.40, Jim, no one's making money. Absolutely nobody. But at $2, there is start to be the odd producer that makes decent money. So yes, Jim, it's going to help Northeast BC, but sadly not as much as it's going to help the other natural gas producers.
What about news that they've made some major oil discoveries in Northeast British Columbia?
Yeah, that's a great sign. And again, we do have a little bit of a transportation issue getting stuff out of there right now because they're discovering so much gas and getting if this oil price rally continues, absolutely, we are going to see we're going to see that oil get developed quite quickly, which is wonderful.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, the website oilandgas-investments.com. Taking a look at also the Canadian supply situation, Fort McMurray slowly coming back online as people are now allowed to return to the homes that remain, and 90% of them were not destroyed, which is great news. Still, that leaves something like 8,000 people without a home. How much of a hit to the Canadian economy did we take with the shutdown of Fort Mac for a month?
Oh, you know what? The Conference Board will come out with those kind of stats, but I would think it's got to lower our GDP. Like when you think of what a high value add commodity oil is, and 1 million barrels a day got put offline for a month. Like, that is absolutely going to, and the ripple effect from that will be even worse. So you're going to see for sure some of that impact. It's big enough that it will absolutely show up in overall U.S. or Canadian economic impact numbers. I don't know if that's going to be 1%, 2%, but it'll end up being noticeable.
Are people in the Canadian energy sector cheering for Donald Trump? He says if he's president, the XL pipeline will be built.
You know, I think at a first blush, the Republicans have always been very much in favor of the Keystone Pipeline, that it just makes sense for the U.S. to import more Canadian oil, friendly oil as opposed to Middle Eastern oil. So I would say yes to the Republican angle. To the Trump himself, I think, you know, that's obviously a bit of a mixed blessing. He's already said he wants to renegotiate the deal that TransCanada cut to get the pipeline down there. I don't know what that means. I don't know if anybody knows what that means. Maybe he wants an extra $1 a barrel tariff or something like that. I don't know. That's you know, that can be as much as $50,000 a day gone from Canadian coffers if that's what he wants. So who knows whether that in itself is going to be something that is good for Canada.
He wants that big gold Trump sign stamped on everything.
Even on it, right, as soon as the TransCanada pipe, as soon as Keystone gets across the border of the 49th parallel, there's going to be a big sign on it stamped Trump.
The OPEC meeting was held and no agreement on freezing or reducing production. The Saudis say they won't take advantage of that. Do you believe them?
Yes, right now I believe them. I think that for now they're seeing the market rebalance. They're seeing that Iran has brought on most of the production that they wanted to. Not all of it yet, but most of it. And the price of oil has still risen. And the price of oil has still risen in the face of a higher U.S. dollar. So the market is clearly rebalancing itself beautifully. And I don't know how long it's going to take, but right now it's looking good enough. I think the Saudis will actually honor their word because it's in their best interest. Not because they're altruistic, but because it's in their best interest.
Well, just a few weeks ago, the Saudis announced instead of giving you a check for what they owe, they're handing out IOUs. They need the money.
They do, and so I don't think the last bit of the story has been written on that comment. That was just a really odd comment, not how business gets done anywhere in the world. So, but we'll see. They certainly, I think, will, without whatever they can do to help themselves and not help Iran, they're going to do.
Yes, I don't think people understand the animosity between Iran and Saudi Arabia as much as perhaps you might.
Well, I just think that we find it here quite difficult to appreciate these sectarian conflicts, even though the Christians have had it as well. You know, you look at Northern Ireland and what a basket case that was for 150 years. So with the Protestants and the Catholics, so it's a very similar thing over there in the Muslim world with the Sunni and the Shiites. So, Jim, I don't know. I just think that it's strange, you know, Jim, because when you go over there, the people actually all get along. The people on the street actually get along with each other. It's the hierarchies, the elites, who really have the vested interest that really fuel the flames, fan the flames of all this sectarian violence. Anytime that I've been over there, whether it was Iraq or Dubai or any place like that, you talk to people who are from all over the Middle East, and they move around from country to country really without a lot of fear.
Why do you think, we've seen so much violence between them? Like you said, it just takes a handful of crackpots to stir the pot.
Well, and like I say, they don't have near the wealth distribution that we do. So if people who bitch about our wealth concentration should go over to the Middle East and experience what it's like to live in a kingdom. Like we have enough prosperity distributed throughout society that everybody, the appetite for corruption is very low. Of course, it still happens, but over there, it's a totally different game. Where if you're not part of the ruling crowd, you're poor, and so there's a lot. To have a vested interest in your group being in control really means a lot economically.
Has it helped the energy sector that China's demand for oil didn't decrease as much as people thought? For one reason, I think, is that the Chinese are in love with their SUVs.
That's what we're hearing. And it's interesting. I wrote a story today, Jim, just on Chinese imports of American ethanol have just skyrocketed. And really, it's a cleaner burning fuel. So I'm sure the reason they're doing this is to get air quality better. So that's been they're finally kind of really starting to address the air quality issue that all their industrial work and cars are putting into the atmosphere.
I know that they still use coal-fired steam engines. Could those steam engines be converted to natural gas?
That I couldn't tell you, my friend.
To me, it would make ecological sense.
Oh, absolutely it would.
And a steam engine, by the way, has a lot more torque than a diesel electric. It takes 3 or 4 diesel engines to replace one steam locomotive. That might be one of the reasons why they're slow to do it. Yes, that could be. If that's true, that would make sense to me. Do air pollution standards make a big difference in the energy sector, or now is that just part of the equation? It happens everywhere?
No, yeah, certainly in North America it happens everywhere. Like we've built that into our efficiency equations for sure. So what you've got is the environmental movement still trying to make it more stringent, which is fine. Who doesn't want a cleaner Earth? And really the industry is just catching up now. But yes, they're absolutely on the whole pollution issue and making sure that their fuel is as clean as possible.
Is one of the reasons why natural gas might be picking up is that in the U.S. they're replacing their coal-fired plants with natural gas?
Oh, of course, yes. Coal and natural gas compete head-on day in, day out for energy generation, whether it's through electricity or other means. So the two of them are head-on all the time. And so most of the large utilities, Jim, in the States are able to switch back and forth between coal and natural gas twice a day if they wanted to.
Has there been much of a movement lately to convert vehicles to natural gas? I know for a while just about every cab was run on natural gas. No. That's just not going to happen. You're going to go electric long before you ever go natural gas. The electric car is absolutely going to kill any thoughts of natural gas becoming a mainstream transportation medium. And the main reason for that, Jim, is like when you can go to a plug-in at a parking lot and pay to plug in your car while you go sit on the beach, as opposed to if you want a natural gas station, it's like building a whole new infrastructure, just like we have for oil. And oil, like Exxon would have to build a whole new set of infrastructure, and that would cost trillions, whereas opposed to a plug, which costs like $1.99. Forget it. Like, it's not even close. There's no way natural gas as a mainstream transportation fuel is dead as a doornail. 7 years ago, Arnold Schwarzenegger was in B.C. promoting the hydrogen highway between California and B.C. Is that ever going to happen?
Not that I'm aware of. I haven't seen a headline with the word hydrogen in it for so long. And every once in a while I check Ballard stock. They were the big hydrogen company, and BLD. And their stock is still struggling around $2 here. Let's just have a quick look at it right now. Yep, $1.82. So hydrogen's going nowhere.
Except on the sun, where they blast off billions of atomic bombs every second.
You got it.
Keith, can you tell us how someone could subscribe to the Oil and Gas Investments Bulletin?
Well, you have to go to my website, which is oilandgas-investments.com, or you can email me. I'm at admin, ADMIN, at oilandgas-investments.com.
Keith, thanks a lot for being on This Week in Money.
Jim, God bless you.
My guest has been Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. Coming up next, real estate expert Robert Campbell on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Robert Campbell, owner of realestatetiming.com. He's speaking to us from San Francisco. Welcome to This Week in Money.
Hi, Jim. Happy to be with you, as always.
San Francisco and Vancouver, both beautiful cities on the Pacific coast. People travel actually down I-5 between the two of the cities, and you feel like they should be sister cities officially. And just like Vancouver, San Francisco is seeing crazy prices for real estate. Can you tell us what the market's like there?
Yes, the San Francisco is one of the 19 cities and major cities in the United States that I track for readers that don't know me. And of those 19 cities, San Francisco is the only one that's in a clearly defined bubble, which I would also put Vancouver in that same category.
Right, and we've just got some recent numbers about Vancouver. Vancouver detached homes up 35% in the past year. The average selling price $1.5 million. And the BC Real Estate Association expects prices to go up another 20% this year. What does that tell you about the market in Vancouver?
Well, I've seen a few charts on it, and the Vancouver real estate market, no question about it, is in a bubble. It's going to burst, and compared to San Francisco, the bubble in Vancouver, I would say, is probably twice the bubble. In San Francisco, let me give you an example. I put that in bubble territory because in the last 4 years, housing prices have doubled. 4 years. Clearly a bubble. I mean, it's probably a 4 standard deviation event, relative to San Francisco norms, and anything above 2 is a bubble where you can expect a sharp correction. So I know San Francisco is going to come down. Just eyeballing the price chart from Vancouver, I mean, you don't need an econ degree to see the direction prices are going, and it's been a moonshot, and there's very little doubt in my mind that that's going to turn into a sharp correction / crash as well at some time in the future. When the momentum indicators turn down, when it reaches its point of highest euphoria, is the moment that prices will start, tumbling back down. But it's a clear bubble.
The chart for prices has gone parabolic. When the parabolic market turns, is there likely to be a mass retraction in price? Will people lose their homes?
Absolutely. I mean, it's going to be. I wouldn't be surprised if prices retreated in the, in the 50-degree range. I would expect something like that. Looking at that chart.
Now, of course, in Canada we have.
And it could be more. It could be more.
In Canada, mortgages are guaranteed by CMHC, Canada Housing and Mortgage Corporation, which is a government organization. Can governments be able to afford to cover these losses? Well,
I'm not familiar with the Canadian banking system and how their central bank operates. That would be no problem here in the United States, Jim. I mean, we've protected our bankers all the way. They'll make these loans, and if Canada's anything like the United States, all these major banks are too big to fail because they figure that the whole economy will go down with it, so they all get bailed out. So it wouldn't surprise me if you did the same thing in Canada.
Right, and just like the U.S., Canada has legislation that would allow them to skim your bank account to make up the difference.
Those are called bail-ins. Absolutely. I didn't know that Canada had that, but yes, that is, in fact, nowadays, maybe 1 in 1,000 people know this, but when you put your savings in a bank, you don't own that deposit anymore. The bank owns it. And, if the bank gets in trouble, gets insolvent, that, they have the legal right to take some of that money that they now have legal title to, that you've given them legal title to, take some of that money, all of that money, some percentage of that money, and confiscate it to cover their losses.
Yeah, isn't that nice to know?
Yeah, great. Well, I mean, for those of our listeners that are familiar with Cyprus, it's the same thing. Exactly the same thing. And that Christine Lagarde, who's head of the IMF, that's what she suggested to solve Europe's lending and banking woes. That they do a bail-in for all savers and confiscate, a minimum of 10% of their savings and give it to the banks so that they're more financially healthy. That is on the books right now. This isn't a thought that's been, just considered. That the banks in Europe, as my understanding is, they have the right to do that across the board, all through the EU, Jim.
Well, same story in Canada and the U.S. Taking a look at the bubbles in both Vancouver and Toronto. Toronto's had tremendous growth too, but Vancouver 35% in the past year, Toronto just under 16%. And a detached house in Toronto is half the price that it is in Vancouver, and Torontonians think they're paying too much.
Right.
What happens? I mean, you have the example of when the U.S. real estate market crashed about 10 years ago now. What kind of thing did you see happen to people personally?
People were devastated, Jim. Absolutely devastated. Anybody that bought at or near the top within let's say 1.5 to 2 years, somewhere in that range. I mean, our bubble burst, let's just call it 2006, and from 2004 on, if you bought a house, you were underwater. So, I mean, there's a lot of volume at the top, like that. Just like we're talking about Vancouver and Toronto right now, and how high housing prices are soaring on an annual, on a 12-month, year-over-year return. The volume of sales is going right up with it. Volume is increasing right with it, because that's what, the increasing demand is what, drives the prices. So the higher these prices go, the more and more demand you're going to see to support these prices. And then when the collapse occurs, the bottom falls out, and all the people that got in within 2 years of the top are just totally wiped out. And in fact, what I'm seeing at the chart is with Vancouver, I wouldn't be surprised if it's 3 years. So I mean, every one of those people are going to be underwater, and that's a lot of volume. Because that's where the sales volume is increasing all the way as the bubble gets bigger and bigger and bigger. Sales volume is increasing because greed fuels more greed. More people want to get on the bandwagon. And the mistake people make, some people were lucky enough, they bought a home in Vancouver, 20 years ago for $250,000. Now it's worth $2 million. And you know what they're doing? They're borrowing against their $2 million home and leveraging up, buying another home. They can't have enough of this stuff. So when the collapse occurs, they're going to lose both homes. That's how nutty people get with real estate bubbles.
And I know a lot of people think Vancouver is bulletproof because up to 50,000 people a year move into Greater Vancouver. But we've seen in Hong Kong, prices there have dropped 15%. Sales are down 25% since September. The Miami condo market now is starting to collapse. They've just got too many condos for sale.
Right.
Can Vancouver expect the same?
Well, and San Francisco as well. San Francisco prices, like I said, housing prices doubled in 4 years, and that include condos. So what's been happening? High-rise condo projects are coming out of the ground everywhere in San Francisco. Some getting started, some getting finished. And, the ones that are being completed right now, what that has done, that has increased the supply of condos by 30 or 40%. And now, so that market's starting to get weak. That's always what happens at the top. People just can't build fast enough and create fast enough to take advantage of the higher prices, and then pretty soon you get oversupply relative to demand, and the whole thing comes tumbling down.
I know the last time we had an economic crash, a lot of high-rise projects in downtown Vancouver were abandoned, and they just left giant holes in the ground for years.
Oh, sure. Same here in San Diego, same everywhere. You know what they do? Where they really get caught is when they're about halfway up. Then they got to keep going. But when they just got the foundation, oh yeah, I've seen foundations sit around in the ground for 5 or 6 years, after the bust, until it was economically feasible again, to restart the project. Oh, there's nothing like seeing a high-rise, all the digging that came out, the concrete that's been poured, the rusting rebar, and you can just see some of the old trailers and stuff they leave there, because when they abandon ship, believe me, there's a lot of crap they don't take with them.
We'll have more with Robert Campbell next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Robert Campbell, owner of RealEstateTiming.com. He's speaking to us from San Francisco. Robert, in the long run, is real estate a good buy for a person, but perhaps not when you have a crazy market like it is right now, both in San Fran, Toronto, and Vancouver?
Absolutely. Long-term real estate has always proven to be a great investment. However, depending on the cycles, you have to be real careful when you buy, and especially when you sell. If you buy up near the peak of a real estate bubble, it can be a long, long time before you even get back to break even. That's the biggest mistake you can make in real estate in highly cyclical markets. And we're talking about places like San Francisco, Toronto, Los Angeles, San Diego. California is famous for its boom and bust cycles. And I am certain that Vancouver and Toronto are going to follow that same pattern. So yes, after you've seen prices rise like they have, look, nobody knows how high this is going to go before it ends. So if you jump on, you better be monitoring the trends real carefully, because if you're in a bubble and you buy, and let's say the Vancouver Board of Realtors is correct and housing prices do go up another 20%, in the next 12 months, but all of a sudden you're tracking this stuff mathematically and on looking at relevant indicators, and all of a sudden you see the momentum start to change, you better get out, put a for sale sign on your place, and bank that 20% appreciation or whatever you made, and get away from the collapse, because it is going to collapse. It's going to be a huge collapse.
If you take Vancouver and Toronto out of the equation, what does Canadian real estate look like?
Oh, that's a great question. I was just looking at a chart, and essentially it's been going essentially flat. There's been some volatility over the last 2 or 3 years, but prices have essentially gone nowhere. Had this huge rise. You guys had a big fall about a year after our real estate crash in the United States. Then you recovered completely and went above the old peaks after that. And since then, there might be a slight upward trend in the last 2 or 3 years, but hardly any. So knowing what's going on in Toronto and Vancouver, that are measured into those, countrywide metrics, I would probably say that at best, Canada housing prices for the rest of the nation are probably flat, maybe even down a little.
Well, of course, if you take Calgary in the heart of the oil patch, a collapse in the oil business has been disastrous for their real estate. Their real estate association says prices are down 4%, but I bet you in reality it's more than that.
How big a market is that? How many people are we talking about in that
market?
Market?
A million people.
Okay. And versus Vancouver now has 3.5, right?
Oh, we're pretty close to 3 million now. Yeah.
Okay. So in other words, what I'm saying is, and how big's Toronto?
5 to 6 million.
See, those are big markets. Those are huge markets. How many people live in Canada? 20 million?
36 million.
Okay, so we got 10 over 36. So a third of the people, let's just round it off, almost a third of the people live in Toronto and Vancouver. And those two cities, housing prices have gone up 25% per year and almost 15% in the last 12 months. And if the rest of the country's flat, that means the rest of the country has to be down, I would think, a little bit, wouldn't you?
I would believe so. I mean, the only
that's
number...
not higher mathematics to figure that out.
Oh, exactly. But of course, the real estate associations are going, but look, the average Canadian price is up so much because of the superheated markets in Vancouver and Toronto, and that distorts the whole country.
Almost, let's just call it, 10 million out of 36 million, that's 30%. That's 30% of the housing market for all Canada.
Exactly.
So, that weighs heavily on those numbers.
And of course, in Vancouver, these high numbers are mostly ultra luxury and luxury homes where you're paying $3 to $31 million.
Exactly. I mean, what I'm reading now is that the median priced home in Vancouver, for the whole city is around $850,000, and Toronto is about $615,000 median price. Yeah. So you start seeing these prices, 1.8 million, 2.5 million. That's the luxury market. I mean, that's all part of that. That's all built into that $850,000 median price. But we're talking about the high-end stuff.
Very high-end.
Whereas San Francisco, let's compare it with San Francisco. The median priced home in San Francisco, when you look at the low end and the high end, $1.3 million, Tim.
And that's U.S. dollars, of course, so we have to add another 25% on to what you'd pay in Canada.
Right.
Is one of the reasons why overseas money is coming here, though, is because West Coast real estate traditionally has held up in bad times?
No, I don't believe so. I just believe because it's kind of high profile and the money's coming over. It's such big money. They don't really, they just want to be in a high profile area like Vancouver, San Francisco, maybe Aspen, Colorado, or something like that, and they're paying all cash for the property. I think that they've got enough money that they're not really analyzing it like the best investment play in the world. They're just trying to get out of harm's way where they're at and get into the next safest place.
Has that always been the way real estate is? People try to get out of trouble and into a friendly place?
Absolutely. It's always been true, especially with capital flows. Money will always flow to where it's treated best. And even if it's not about a real estate thing, but if all of a sudden, some country in the world like Thailand or something is experiencing, great economic growth and everything's just booming away, money just, global money just flies into those areas and inflates those markets even more. And then when it's over, when it's bust, hey, that money's long gone. That money can disappear as fast as it came, and it kind of leaves the country in ruins. Remember what happened to Iceland during the 2008 financial crisis when their banks were booming, and all of a sudden everybody pulled out, and the country just collapsed. What you have to be aware of is, like when we're talking about international capital flight, that's hot money, Jim. That's hot money. It comes and it can go. In Europe, they don't want to keep their money, let's say, in Vancouver. It's in Vancouver, to protect it because it's a safe haven right now. Everything considered, when Europe, finally crash and burns, that money will head back to Europe because that's where these people are from. That's what money does. It always tends to return home.
Robert, how can people find out more about real estate timing?
They can go to my website, which is realestatetiming.com. Realestatetiming.com. It's just like it sounds, real simple with no dashes or dots or anything. They can buy my book, Timing the Real Estate Market, or they can, if they subscribe to my timing letter for 1 year, I'll give them that $35 book for free. And there's other stuff on there that you'd be really interested in knowing about too. I've had that same website for 14 years, so you could just go there if knowing the best times to buy and sell real estate is important to you, whether you live in San Francisco, Vancouver, or Toronto. I think you'd find the information there very helpful.
My guest has been Robert Campbell. Thank you very much for being on This Week in Money.
Thank you much. Look forward to talking to you again, Jim. Bye.
My guest has been Robert Campbell, owner of realestatetiming.com. And that wraps up our show for this week. I'd like to thank our guests Ross Clark, Keith Schaefer, and Robert Campbell, and thank you for listening. If you have any questions or comments for the show, you can email them to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.